You're listening to the All-Star Charts podcast with JC Peretz on technicalanalysisradio.com.
All right, everybody. Today, we are joined by Julius de Kempenaer. He is the creator of the RRG, the Relative Rotation Graphs. Julius, thanks for being here.
No problem, JC. My pleasure.
I have been a big fan of your work for a long time. I believe I discovered the RRG many years ago at a Bloomberg presentation that I went to see, and a good buddy of mine was kind of just showing it off, and his name is Paul Sienna, and I was like, wow, this is really cool. So I wrote a blog post about it, and I guess maybe like a year later or so, you approached me. You're like, hey, JC, thanks for writing that blog post.
Exactly. Yeah, you were actually one of the first that picked it up when it was launched on Bloomberg. So that is many years ago.
Yeah, when was it, 2012? Is that too early?
It was launched on Bloomberg in January 2011. So your post probably was 2012. Could very well be, yeah.
Yeah, blog post 7 years, that was a long time ago. So I found it just very interesting, just visually. For me, I guess I'm a visual person. I'm a technical analyst, right? So I look at pictures all day instead of balance sheets and income statements, fortunately. What inspired you to do this? How did this all start?
Yeah, I mean, this all started to emerge when I was working as a sell-side analyst on the trading floor of a Dutch investment bank, Kempen & Co. And my job was to basically sell research, sell ideas to institutional investors. And as you know, these guys the direction of the market in general is sort of interesting to them, but they're not in a position, even if they are 100% sure that the market is going down, to sell all their holdings. So what they are really interested in is relative strength. They need to know which sectors or which parts of the market are outperforming other parts of the market. So that was sort of my framework in which I had to work. And a problem that you run into when you're in a job like that is that these portfolio managers are notoriously hard to get a hold of. Very often you find yourself talking to voicemails, or you try to shoot some emails that they never read. So it's extremely difficult. And when you reach one of them, I mean, you're a technical analyst, so am I. So our universe is way bigger than most fundamental analysts. So what you do when you are in a position as an analyst, you prepare a couple of stories of which you think that they make sense, and you start calling your clients. So you call your client and, hey, Bob, how are you doing? Blah, blah, blah. Hey, listen, I have some ideas in the financial sector for you. Oh, Julius, stop, please stop. I mean, this week is technology week. Tell me all you know about technology. Clearly I didn't prepare anything in technology. So you just start shooting from the hip, and it's very difficult to get that story in front of these guys. So I wanted to have something that I could use to rank my universe. That was my first intention, because all these guys were asking, what are your best 5 picks in technology, or what are your best 5 sectors? So I wanted a tool to rank based on relative strength, and then not the tool that I know that you're in the US, and the most people in the US, they use like 3 or 6 or 12 month look back periods, and then if something is higher than 12 months ago, they say it's got positive relative strength. But I'm actually interested in what's going on during the course of that 12 months. So I'm trying to pick up trends in relative strength. So I worked out some sort of a ranking algorithm that I could use to answer that question. That was the first thing. That is what is now known as the JDK-RS ratio. That was my first measure to rank universes based on relative strength.
This is in the 90s?
This is in the late 90s, yeah. And then actually spot on, because somewhere in 2000, right in the dot-com bubble crisis, when technology sector was like way up there. So my RS ratio was like, over the clouds. And then things started to turn around, and technology started to come down. Clearly my algo is sort of, there is a trend following element in it. So it doesn't respond immediately because it tries to pick up trends. But that trend change in technology in 2000 was so fast that it took a little bit of time before my algos picked that up. So I got an email from an Italian investor saying, hey, Julius, this time your system didn't work so well. Well, okay, so he's got a point there. So I started going back to the drawing board, I need some sort of a early warning system, some sort of, things that can give me clues of where these trends are going. And then very rapidly you end up with rate of change and momentum indicators, because they are leading indicators. So I was looking at trends and I was looking at that, and then you run into all sorts of problems when you try to do ranking with relative strength, because these raw, I call them raw relative strength numbers. You cannot compare them. You cannot compare the raw relative strength of technology with the raw relative strength of, let's say, healthcare, because the numerical values make no sense. So I figured out a way how to do that. That became the RS momentum, and I used that for quite a while in my publications. I published tables, sorted on RS ratios, sorted on momentum, tried to make up my mind, and looked at a lot of charts with these two lines. And then, I sort of could answer the question, what are the best 5 or the best 3? And then something happened. That was in 2004, I think. I got an intern at my desk. It was a smart cookie, and I asked him, can you take a look at all the monthly reports that I wrote that were sent to our clients over the course of that 4 years, and measure the performance of those recommendations? And a recommendation was either outperform, neutral, or underperform. So he does that. He goes out there. I have to say that those reports were based on, or were loosely based on, a system and rules, but I was the ultimate judge. I was making the final call whether I was going to put some sort of a recommendation on it. So there was some sort of subjectivity in those reports. Nevertheless, he went back, he did all those calculations, came back, says, well, it's good news, there is a significant outperformance over the benchmark, which was a European sector universe, which is nice. But I thought, okay, that's nice. Now we have 4 times 12 is like 48 reports. That's not too much. It's nice that it's outperforming, but it's not too much. So what we then did is we sort of formalized the rules that I was using in my head, and ran the same calculations on history that went back to 1987. Dow Jones Stocks provides historical data back to 1987. Comes back, does the same exercise, says, hey, again, good news, significant outperformance over the benchmark, although a little bit less than the reports that you wrote over the course of 4 years. We could say that, hey, that was my subjectivity was adding value. I think it's better. It's more justified to say that it was just a matter of number of observations. But then he did one thing that was very interesting, and that was he went back and he took all those occurrences since 1987 when a sector was labeled outperform and a sector was labeled underperform, and he calculated what the relative return was 3 months after the switch to that signal or to that recommendation. And what he found out was that the excess return, so the alpha captured on the underperformance recommendations, was much, and I mean much higher than the alpha captured on the outperformance recommendations. And that got me thinking.
That's really interesting.
It's super interesting, because what it meant to me was that, and I started telling them that when I talked to these PMs and they asked me, what are your best 5 sectors? I said, hey, you're asking me the wrong question. You're not asking me what are the best 5 sectors. You should ask me what are the worst 5 sectors. What should I avoid? And when I do presentations now, I always ask the audience, I say, hey, if you're honest with yourself and at the end of each year, you look back to your portfolio, I am 100% sure that each and every one of us can pinpoint 3, 4, maybe 5 positions of which they say, hey, if I would not have had those positions, my return would have been so much better.
Yep.
So that was a thing. I thought, hey, I really need to bring this in front of these very, very busy people, but how am I going to do that? So I started playing around with it, and then it must have been a Sunday afternoon on the deck, something like that, with a laptop and just playing around with some data and some spreadsheets that I was holding, because that spreadsheet that I built was now like, 6 feet wide and 6 feet deep, and I was the only person that could read the Visual Basic code behind it, etc.
Sure.
And I was playing with it with those momentum and RS ratio indicators, and with the various graphical solutions that Excel gives you. And then all of a sudden I had it up on a scatter plot, and I thought, hey, this is interesting. What is it what I'm actually looking at? And that's how the idea of relative rotation graphs actually started to take shape. And in the beginning, because I had that and I thought, hey, this is cool, I'm going to communicate that with my clients. And in each sector report, I plotted that scatter plot with those dots. At that time, they were just single dots around it. And after a while, I thought, hey, these are still snapshots in time. They're one-offs, and we're technical analysts, so we like to see a little bit of history, etc., etc. So then I programmed up, and at that time I did it all myself, the previous observation, and I connected, each sector with its previous observation. So I got little pieces, little segments of lines of what are now the tails on that scatter plot. And I started to send those out. And I'm sure you guys know Dave Keller.
Of course.
Yeah, so Dave at the time was managing director of Fidelity Research, and he was one of my clients. He was a big fan of relative strength stuff, and I sent him all my stuff, and we had the occasional phone call every couple of weeks. And at one occasion, I was talking to Dave on the phone, and then he said, you know what I do with all these with these PDFs that you sent me? The last page of that report, I print out and I stick it on the wall. And then after a couple of weeks or a couple of months, I stack them all together. And when you were in high school, when you had these notebooks and you draw a little puppet on one page, and then on the next page you draw the same puppet, but it moved a little bit, and you did that for a lot of pages, and then you just like. You know what I mean?
I do, actually.
He did that with a stack of printed, the graphs that I had, which then actually showed you how they started to rotate. And I thought, hey, that's freaking cool. I mean, so let me see if I can, get that to work. So I went back to the drawing board and started to doing that. And that's how these tails came to life and started to become longer, and you actually saw these rotational patterns taking shape. And that was like, wow, this is sector rotation. It shows you sector rotation, because everybody was always talking about sector rotation, but nobody was ever able to show me that they were actually rotating, and they're actually rotating in a clockwise fashion around the benchmark. And when I had that, I could go back, because now I had one picture that would show the complete universe of, in that case, European sectors. Nowadays it's more US sectors, but you could show a complete sector universe. But you could also tell these PMs where they should not be, because it clearly shows you where the, in the lagging quadrant, where the underperformers are, what you should avoid. So this tool gave me the opportunity to put sort of all that information right in front of that PM, avoiding that question, it's technology week, give me your 5 best picks in technology. Bit of a long answer, but that's where it came from.
And as far as, okay, so if for somebody who's new to the RRG, can you explain the way that it rotates, right? So it's essentially rotating around whatever we're looking relative to. So I guess the benchmark.
Exactly. Yeah. I mean, this is a podcast, so we have to describe it, because it's a very visually orientated tool. But you got to imagine a basic scatter plot. So with the Cartesian axis, on the horizontal axis is the RS ratio, which is my measure of trends in relative strength. It's not per se relative strength itself, it's trends in relative strength.
Yeah.
And then on the vertical axis, it's the JDK RS momentum, which looks at the rate of change of the momentum of those trends in relative strength. Now, those 4 quadrants are very distinct. So in the top right-hand corner, so the by the way, the axis cross at 100. That is the middle of the chart. So when you have an RS ratio above 100, that means that the relative trend versus the benchmark is up. When you then also have a RS momentum value above 100, it means that that trend is still being pushed higher by strong momentum. So all those sectors or securities end up in what we call the leading quadrant, which is the top right hand of the RRG chart. Now, the first thing that happens is that momentum, rate of change, will start to roll over, and it will push that sector into the lower right-hand quadrant, which is labeled weakening.
Yep.
The relative trend is still up, but it's losing strength. If that loss of strength continues, then it will eventually rotate into the lagging quadrant, which is the lower left-hand corner. There you'll find the sectors that have a weak relative trend versus a benchmark, and that trend is still being pushed down by weak momentum. And then after a while, also here, momentum will be the first to pick up, starts to roll over, and push the sector into the improving quadrant, which means that the relative trend is still down, but it's picking up strength, so it's starting to curl upward. If that strength continues, it will eventually rotate the sector back into leading, and you'll have a full rotation going through all four quadrants.
So for those listening, we're going to put the charts in the show notes. So definitely go and check those out so you can see visually how there's essentially 4 different quadrants. On the upper right, it's leading. Lower right, it's weakening. Lower left, it's lagging. Upper left, it's improving. And then it just rotates clockwise like that. And then what I find really interesting, Julius, is that you can change what you are trying to compare these securities to. So the benchmark could be the S&P 500. It could be a European index, right? It could be a lot of different things. My big question that I always come to you with is that when these tails are moving around, right? These sectors are rotating, if you will, in the relative rotation graph. The data around the outside, in other words, the trends around the outside of the RRG are more intact than the ones closer to the middle. Rick, can you explain that to me a little bit better?
Yeah, I mean, and that's perfectly explainable. No, that's not an English word. I don't know. I mean, you can perfectly explain that, because what it actually means is that if something is far away from the benchmark, first of all, it means that there is a strong trend, because the RS ratio is your measure of trend. So very high values are good and very low values are bad. High values are uptrends, low values are downtrends. But if something is very close to the 100 level, it actually means that it's moving very close to the benchmark. So it's moving in line with the benchmark. And if something is moving in line with the benchmark, there is not much alpha to be captured. So stuff that's moving on the outside of the RRG is always very interesting to look at, because there are the best opportunities to generate alpha. There you'll get your biggest outperformance or underperformance.
And then so I constantly see these things rotating clockwise, and you could see the tails, really. You could see like where they've been. But then sometimes they won't rotate clockwise, and they'll kind of just get a little bit out of whack, right? And start kind of going in an opposite direction, maybe even temporarily. How often do you see that? What does that really mean to you when they're for a period of time not rotating clockwise?
Yeah, well, let me clarify one thing. They always rotate clockwise. However, you may not be able to see it. And what I mean by that is, in my work, I most of the time use a weekly RRG, which uses weekly data. But we can actually run RRGs on dailies, on monthlies, and even intraday, hourlies, 30 minutes, 10 minutes, whatever you want. Now, what you are describing is when you have a situation where, let's say on the weekly, you have a nice rotation and the tail curves around, and then all of a sudden you see some sort of a hook, going to the right, or it looks as if it's moving the other direction. What happens is that the rotation is taking place so quickly that the weekly is not picking that up. When you move down a time frame from weekly, let's say, to daily, you will see that what looks like a hook on the weekly is actually a rotation on the daily, and it's again a clockwise rotation, but it's so fast that the weekly doesn't have enough time to actually display that rotation. So when you see those occurrences that you just described, I tell people to move down to a time frame lower, which responds faster, and you will see again that it is a rotational pattern that the security is going through.
That's really, I love that you're here because I get to ask you all sorts of questions that I want to know selfishly. So I hope the audience appreciates this as well. I'm going to fire another one at you. What are some of the ways that you and I haven't discussed right now? What are some of the ways that you've seen other people, whether they're PMs or analysts, use the relative rotation graph? How do you see it used the best?
It's a very wide audience. It ranges from buy-side, long-term portfolio managers and analysts to actually prop traders in the currency markets. And for example, I have a couple of guys that use relative rotation graphs for currencies, and they have 5-minute RRGs for the currencies that they are trading or need to make a market on.
I'm getting dizzy just thinking about it.
Well, what it does, what I come from a military background, and I hadn't even thought about that. But at one stage, a guy in the audience said, "This is perfect to give you a situational awareness." And if you have like me, an Air Force background, one thing that keeps you alive when you're in the air, or if you're, in the military on the ground, is situational awareness. Knowing where your enemy is, knowing where your friends are, knowing what's going on around you is super important to stay alive. And what an RRG does, it gives you situational awareness of the financial battlefield, of the sectors, of the asset classes, of the currencies, of whatever. So what these guys do, they have this 5-minute RRG of currencies, and when they just keep an eye on it. They don't use it so much for trading per se, but it gives them a clue on what people are doing, and if something starts to move, especially if some currency pair starts to move far away on the outside of an RRG, for them that could be a signal to dive in and see, hey, what's going on here? Did we miss any news? Did something start to move, etc., etc. If you move to the very far end of the spectrum on the other side, is where you have your portfolio managers at Fidelity and Wellington and all these big institutions, who they cannot move. I mean, if they want to build a position, it takes them like a week or longer to just get the position they want. So they need longer term views on which sector is going to outperform, or which country or which region is going to outperform. They use RRGs to get an idea, to get a handle on where all these sectors are vis-a-vis each other and vis-a-vis the benchmark, and where potential new possibilities of capturing alpha are arising. And which is what I always advise people, never trade on an RRG as such, because they're a visualization tool. They were never designed to be a trading system. And I believe that no matter how much I like RRGs, they should be piece of the puzzle, and everybody builds their own financial puzzle for what they want to do. And RRG is just a tool to help you solve that puzzle or make investment decisions. So yeah, lots of different people with lots of different investment horizons and lots of different goals are using RRGs nowadays.
I love that you say that, how it's just a tool, right? It's just one piece of the puzzle.
Oh,
And
yeah.
I think that's true of everything. Not everybody, obviously, you and I, we speak with sophisticated customers who are aware now, but maybe some people who are new to the market, they're in search for this holy grail, like this one indicator.
Yeah.
And as cool as RRG is, particularly visually, it's just not that. But that's okay because nothing is that.
Absolutely.
So let's talk about now. I'm looking at a weekly RRG. We are here on March 26th. We're recording this, so I'm looking at a weekly RRG, and technology has just entered the leading quadrant,
Yes.
to joining both industrials and consumer discretionaries. So right off the bat, just as somebody who looks at charts and looks at relative strength, I see three very important sectors in America: tech, industrials, and consumer discretionaries, all in the leading quadrant on the weekly RRG. So what should that mean to me?
Yeah. Technology sector, there's no doubt about it. That is actually a super strong move. And I like that very much. That is that is a very strong move. It's inside leading. It's coming from improving. And what I always look at is what I call RRG heading. And RRG heading is the direction in which that tail is moving, and you measure that from the previous observation to the current observation. And you gotta put it on like a compass when you're on a boat. It starts at 0, goes all the way around to 360. So due east is 90 degrees, due south is 180, and due west is 270, and then north is 0 or 360. Anything between 0 and 90 degrees is gaining on both axes. That is strong. And technology is doing exactly that. It's gaining on both axes. Now, industrials and consumer discretionary, they're inside leading, but they very soon after they entered leading, they started to move south. So they're heading like at an RRG heading of 90 degrees. That it can still become better, but at the moment I am not too fond about them. I mean, I like technology a lot better. What I am actually looking at is utilities and real estate, and especially utilities, because if you look at the tail of utilities, and the people will be able to see that on the chart that you're going to post, what you see there is that utilities, first of all, it's got a super long tail, and the length of the tail tells us something about the power behind the move. And again, I mean, that makes total sense. If you think about it, a very short tail means that the distances from week to week are very short, so not much is happening. So a very short tail is like, all right, it's moving, it's doing its thing, but it's not really going anywhere.
Like financials, for example?
Yeah, exactly. Yeah, and materials, I would go into that direction. Consumer discretionary is like smack in the middle.
Yeah.
It's relatively short tail, but it's smack in the middle, like at 100, so on top of the benchmark. So I would sort of, you can look at the chart and you can make up your mind on the chart, but from a relative point of view, there's not really much going on. If we go back to utilities, it's got a super long tail, so it indicates there's a lot going on. But what's very interesting, earlier on we described the process of rotating through all those 4 quadrants. Now, in an ideal world and in the model, sectors rotate through all 4 quadrants. Unfortunately, or fortunately, the real world is not the model. So in the real world, different things happen. And what you will see happening quite a lot, actually, is that rotations will take place completely on the right-hand side or completely on the left-hand side of the RRG plot. If they take place completely on the right-hand side, that indicates a very strong relative trend. You know that you can draw a raw relative strength line, like the ratio between a sector and the benchmark.
Sure.
That is almost not a straight line. That behaves like a market. It's got higher highs, higher lows, got support, resistance. You can do a lot of stuff with that. What that RS ratio does is trying to pick up trends in that ratio line. So when that ratio line is making higher highs, higher lows, then the process from going from a higher high to a higher low means a temporary loss of momentum.
Sure.
That loss of momentum causes that tail to move from leading into weakening. Now, when that higher low is being put into place and that longer term relative uptrend starts to materialize again, that security or that sector turns around inside weakening and starts to make its way back up to the leading quadrant without traveling through lagging or improving.
Yeah.
And I think that that's what we're seeing now with utilities and with real estate.
That's really interesting. Really showing that flight to yield essentially as interest rates have been collapsing. So that really would make perfect sense. And let me ask you this, Julius, because you're a trained technical analyst. Can you, just by doing your non-RRG work, can you, like, off the top of your head, kind of imagine what that rotation graph is looking like?
Yeah, I can now do that. Yeah.
Like, you have a pretty good idea of what it's going to look like before you pull it up?
Yeah, but also, which I think is much more important and interesting, at least for me, is that I can, from an RRG, almost, imagine what the chart looks like, or the relative chart looks like.
True.
So that's how I sort of pitch it to people. I mean, I tell people, use this as your starting point. You look at the RRG, you got a big high level overview of what's going on. So from that chart that we're now discussing, that US sector RRG, I would immediately pick up technology, utilities, real estate. Those are the sectors that I immediately want to look at. And then, if I dive a little bit deeper, a couple of relationships that I like to keep an eye on, for example, consumer staples versus discretionary. Despite the fact that discretionary is on top of the benchmark, staples has turned around. It's inside lagging, but it has started to turn around, and it's now moving higher, and it's starting to move opposite to the discretionary sector again. So it looks like as if staples is picking up versus discretionary again, and that's a relationship that I'd like to keep an eye on, because normally when staples are doing better or outperforming discretionary, that's usually not too good for the market in general. And with the market being at the levels where it is right now, makes me cautious.
So the technology stands out from the strength side. What we're seeing in utilities and REITs as well. Staples kind of turning around is, evidence of sort of that risk aversion, right? When staples are outperforming, that's really interesting. What else? Anything stand out from a non-sector RRG perspective? Anything globally?
Yeah, I actually wrote a blog about that not too long ago on stockcharts.com, looking at international markets. As a matter of fact, I titled it Europe versus the USA, and the winner is China, I think. I mean, because if you bring up an RRG of a number of major world markets. Oh, by the way, I mean, we need to discuss this because your audience is sort of all American, I assume. Right?
No, that's not true.
No, not true. Okay.
No, we have a lot of European.
Very good. The problem is that a lot of people, when they look at international markets, they look at ETFs. So they throw a bunch of ETFs on a chart, or they analyze ETFs that cover, I don't know, Europe, Hong Kong, emerging markets, Brazil, Mexico, you name it. But what I am always puzzled and amazed that even professional analysts and investors look at global markets through the eyes of ETFs.
Dollar-based.
Exactly. And that is such a different picture.
Yeah.
So when I run RRGs on international markets, I always use the index. I always use the underlying index because I feel that these give me the proper relative picture of the performance of those markets.
Yeah, local currency.
In local currency. Yeah. And it means that if we find something that we like or not like, and we're going to make a transition to a position in our portfolio, we may end up buying or shorting or doing something with the ETF, but we will then introduce a currency position in our portfolio, and we have to deal with that position separately. I don't think that decision should be part of the decision whether to buy or sell that stock market. Okay, that as a side note. If you look at
But Julius, what is the benchmark that you use when you're looking at globally? Are you using like an an ACWI or something like that?
Could be the MSCI World, could be the Dow Jones Global Index.
Got it.
For me, JC, it's for me, it's the same as like some people say, oh, if I talk about moving averages, what moving average are you using? 25 or 50 or 30? And my answer is just pick one.
Yeah.
I don't care. They all look the same. There's a big difference between 5 and 50 days. Okay, that's fine. That's your short term and your long term. But whether it's 49, 53, or whatever, I don't care. It's looking at trends, it's trend following, and that's what it's doing. With setting up an RRG at a high level like global markets, MSCI World, FTSE All World, Dow Jones Global, pretty much any global index that you stick in as a benchmark will show you the same rotational picture.
Yeah, no, that makes sense.
So to come back to your question, what stands out? What stands out is that the US seems over the past few weeks to have regained its strength versus Europe, but both are losing out versus China. And if you look at the RRG, what you will see is that the Shanghai Stock Exchange Index is inside the leading quadrant, and it's powering higher at a very strong RRG heading, almost 45 degrees, which is the strongest that you can get. And it's one of the few, or well, maybe the only market at the moment that is moving in at an RRG heading between 0 and 90 degrees, so higher on both axes. So it's pretty much outperforming anything else. So I like China for the time being.
That's really interesting. And then what about from a risk management standpoint, right? So we've talked about, hey, this sector stands out in strength. This sector, like you said, one of the most important things is seeing what's not working, right? Which sectors are the ones we want to stay away. So that's a great sort of risk management tool. But let's just stick with the more positive side, right? So let's just say something like technology. So that stands out to you right now.
Yes.
What would we look for? What should we be looking for as evidence that something has changed? And we could say, well, no, what we were getting excited about in tech the last couple of weeks is now no longer the case, right? You understand what I'm saying?
Yeah, I know what you mean. Again, depends a little bit on your time frame. But I would start to look, because it's in leading now on the weekly. So as soon as you see that tail to roll over inside leading, when it starts to lose relative momentum, that's when I start to become, well, not nervous, but I start to pay attention to what's going on. And that's sort of an early warning signal for me.
Is that when it turns south or turns west?
No. You gotta lose momentum. So it needs to have like a south in the heading. So I would say below 90 degrees.
Got it.
Yeah, because there are it's very well possible that something, enters the leading quadrant and then just levels off a little bit. Sometimes, goes a little bit sideways and then picks up. And, those are these relative trends that just carry on, but with stable momentum. So they are continuing higher, but it's not gaining more and more and more every week. It's just gaining the same every week. So that's when you sort of move horizontally through the RRG plot.
And Julius, so for the listeners out there, where can they go and learn more about RRG, install it in their software, start using it as part of their process? What do they do next?
Yeah, we are partnering with a number of data vendors and platforms. The most well-known and the first one is Bloomberg, still there. RRG Go for everybody who's got a Bloomberg terminal. Then it is on Thomson Reuters or now Refinitiv Icon terminals. We have a long-standing partnership with Optima software. I know you are an avid user of Optima as well.
My personal favorite.
Yeah, they have the most extensive toolbox around RRG. They have all the derived indicators. You can scan, you can test, you can sort, you can pretty much do anything you like. You can signal test. And then for the broader audience, stockcharts.com is my most important partner. And they are what we call the home of RRG on the web. And every stock charts customer has access to RRG charts, and they can customize them, set their own benchmarks, set their own universes, scroll through history, etc., etc. And if you have any listeners in Hong Kong, they can go to a website that's called EJFQ.com, and that's a partner site of the Hong Kong Economic Journal, and they are our partner in Hong Kong for the Hong Kong stock market, which is quite funny because that was the first time I saw my own RRGs in Chinese, and I had no idea what they were telling about.
That's really funny. I mean, I love Hong Kong, so we can go out there and learn together.
Absolutely,
Okay,
yeah.
So then these are the places where investors and analysts, PMs, can go and start using it. Where can they go and learn more about perhaps its construction and some ideas on how to, change things around?
Yep, we have our own website, which is relativerotationgraphs.com, all one word. There is some material there. And the website of Optima, Matthew Verdau has done a good job with some videos and some blogs. And then on stockcharts.com, there is quite a lengthy section in the chart school, which is freely available to people, as well as my blogs on stockcharts.com. If you go to the blogs on stockcharts.com and look for the RRG blog, then you'll find me writing roughly three to five times a month. And every Thursday, I write a short piece on Don't Ignore This Chart, which usually involves an RRG as well. So yeah, there's lots of places where people can find information about it.
All right, everybody. I hope you enjoyed this conversation. Julius, thank you so much for being here. I'll see you in New York next week.
For sure. Looking forward to it.
Thank you for listening to the All-Star Charts podcast with JC Peretz on Technical Analysis Radio. To see all of the charts mentioned on today's show, please visit allstarcharts.com/podcast.